Good morning, all. Steve Parisi here with IBC Global. I hope the day is off to a fantastic start. Today, we have a long timer here at IBC Global, Mr. Steve Timmons. We're going to have a fun topic that we're going to discuss, which is borrowing against real estate, borrowing against your home, or against a life insurance policy. Which one is better? Before we get into that, Steve, how you doing, my friend?
I'm doing great. Thanks for asking.
Oh, always. Nice and chilly over by you today, right?
Yes, it is. It's time
Yeah.
for the corduroy and time to stay warm and keep going.
Yep, same thing over here. It is that time of year. But today's podcast is not about the weather. So the question we're going to discuss is something you brought up, and I really like the way you explained it because it's how a lot of people feel about this topic, which is should I borrow against my home or real estate if I own it, or against my life insurance policy? So we'll discuss the pros and cons of both because there's benefits to both. A lot of people are extremely successful leveraging their real estate. So we want to talk about the benefits to that, but also where the life insurance can come into play. Where I'd like to start, if you'd like, is what you went through personally, where you had mentioned you had a long time job, stopped working there, or you're no longer working there, and ran into a situation where you said, "Hey, I've got this equity in my home," but then you came up against a roadblock. I'll let you elaborate on that. Fire away.
No, it's an interesting concept because we were told to basically pay down your house as soon as you can, get out of debt, be debt free. So I was always trying to put extra money towards the house, and I always used it as a security aspect of saying, "Oh, I'll always have, an exit strategy." And came to a situation where my position was removed, and all of a sudden I'm like, "Oh, okay." Had a couple of months of savings, went through it, and then said, "I need to have some extra cash." So I went to the bank and said, "Hey, I'd like to take out, a reverse mortgage." And they're like, "Yeah, what's your income?" And I'm like, "Well, it's zero right now." And they're like, "Well, we can't give you a loan." And it was one of those surprising aspects of like, wait a minute, I thought I was supposed to be able to do a reverse mortgage. But what people basically don't tell you, or what I never heard was, oh, make sure you have a line of credit set up. And so with that, all of a sudden, everything kind of started playing into it to say, while you still have a job, make sure you have a line of credit set up. And there's several ways to do it. One, you basically go to the bank that you're working with, or two, you can look into a life insurance policy because the money that you put into that, you're building up a line of credit. You're going to get an area of interest where you're going to be paid for the money that you put in. So you get those dividends and guarantees that builds up. And now you have several options. And you have the option to either take it from your life insurance policy where you have a fixed rate. And as the rates are changing, it's like a big pendulum, right? The rates were very high and then they got down to be very low. Banks weren't paying you any type of interest. And now you have a line of credit, and that line of credit hopefully is giving you high yield interest. Life insurance policies, at around 5%. It's an ideal aspect.
Yeah, definitely. Thanks for sharing that. So let me ask this. So at the time when you went to the bank wanting to take a reverse mortgage or access the equity in your property, how much was there in equity?
I
Ballpark.
had over $150,000 in equity.
So you had equity available, but you couldn't access it just because of the situation at the time. Right now you could. It was just based on right after you had moved on from your previous company, the income wasn't there, so that's why you were restricted. Correct?
Correct.
Got
Correct.
it.
And again, nobody ever told me that, oh, while you still have a job, just go to the bank and ask for a loan. And you're basically,
Yeah.
you don't have to execute against it. All you're trying to do is just give me a line of credit so that way in the future I can go and tap into it if I need to.
Get it
And
established. Yeah.
yeah, and if I had the life insurance policy set up at the time, that would have been a perfect opportunity, to do the same thing.
Yeah, got it. What was the interest rate at that point in time?
For the mortgages, they were low. So people were getting loans, 2%. It was scary to see how
When,
low it could have been.
yeah, when was this? Do you remember what year?
This would have been like 1919 or 1919. How about that? How
Yeah.
about 2019?
2019. Okay, so a little bit before COVID. Yeah, interest rates were low back then. Okay. And then so fast forward to today, are you in a position now where you do have a line of credit just available on your property?
Yeah, absolutely.
Nice. And what's the interest rate now?
So right now you're getting anywhere between 6 to 7%.
Okay,
So
not bad.
it's not bad. It's just one of those things where you have the 6 or 7 and you can choose. And I've seen several things out there too that says as long as you utilize it for what you need it for,
Yeah.
it doesn't matter what the interest rates are. You just have to say, I'm going to be, disciplined enough to say, pay the interest only, pay, the principal and the interest, pay it off quickly, or, just depends. What are you trying to use it for? Get me by a couple of months, get me by for the next, year or two. Just what is it that you're trying to get into?
Yeah, I agree with that. I've got a line of credit on the commercial property that we own. I've used it once in the past for the business. Haven't used it in years, but similar to what you mentioned, it's there just in case, and it's really capital for the business in the event we wanted to use it. Or if the interest rate's high, you're like, it's not what it used to be, but at least the capital is there. I mean, that's typically how I look at it and how most people look at it. I mean, it's money to move into an opportunity and have fun with.
Right. And
Yeah.
that's what already tell my clients too. It's leveraging it. It's more
Yeah.
or less to say you have several buckets of money. You've got a bucket over here that you want to be able to pay for right away. You have another one that you could like say, it's my terms and conditions. I can pay it back in 5 years. I can pay it back in 5 months. I can wait a week, whatever it is. But it's my terms as opposed to this one that says you got to be paying it next month. You got to pay this much money,
Yeah.
etc. So it's giving you some leverage to say, let me put it on my terms and conditions, and then I can go ahead and make this one go away later on.
Got it. Okay. So let's go through this a little bit. How do you explain to your clients the benefits or pros and cons to both? You started it right there as far as if I'm a potential client, I'm interested in a whole life insurance policy, but how I've built my wealth, say I've got an investment portfolio, all rental properties, and I've done that by accessing equity in the real estate that I own. Because a lot of people we work with, I know, do that. So I come to you and I say, this is what I've always done and it works. Like I've been successful with it. So I don't want to change what I'm doing. Like I don't want to fix something that's not broken. But what do other people do with whole life insurance, specifically the cash value, and why? Like why would I do something different that's worked really, really well? Like how would it benefit my current situation?
Sure. It's more or less not that we're changing anything drastically, we're just tweaking it. It's the same flow of cash. It's just more or less moving it from one bucket to another. And with that, by moving it into a different bucket, you might be getting a bit of extra interest. Most people that I talk to, for example, they're putting it straight into a bank account. Or if they're not taking it into a bank account, they might be giving them 0%.
Right.
Then the question is like, where are you getting the cash from? Oh, well, I'm selling my stocks. And I always ask, well, it's nice if the stocks are up because then you're selling your profits and you can take advantage of it. But what if you were like 2 years ago, 2022, where it was down by almost 19% in the S&P 500? You can't wait for it. Oh, maybe next month or maybe 2 months from now, that opportunity that you're trying to leverage your cash might be gone and you'll lose out on something that could have made a lot more cash. So are you going to take it at a loss? It's more or less finding the right bucket that's going to be more efficient for you.
Got it. So speaking about the cash value and the whole life insurance policy, a place that can store some excess cash that'll actually earn interest as time passes.
Correct.
Yeah,
Correct. And all
got
you're
it.
doing is you're just leveraging it because as you're getting dividends and you're getting the guaranteed growth in that policy, then it becomes a time to say, you know what, I can either take it and I know what my interest rate is on that one. And it might be a small amount, maybe, anywhere between 5 to 5.7 or so. But if you know what that interest rate is, then you can compare where else am I going to get the cash?
Yeah,
The market's down. Oh, that's too bad. Or hey, the market's good. Okay, you have options, but can you live day to day wondering in the future, this is what I've always done, and you're always playing on the market if that's where you're putting your cash. I'd rather
yeah.
have a more safe aspect, a more, conservative aspect of where can I get my cash.
Yeah, and that's typically where I like to start too. So if I'm your real estate investor prospect, I've got interest in whole life insurance. The first thing that I'll typically do, and it sounds like this is exactly what you do too, is explain the benefits of the whole life insurance product. Where I always like to start is how people often view the cash value is as a safe place to position money, meaning regardless of what happens in the market or the economy, whatever, it'll continue to appreciate over time. The growth rate, I usually like to set expectations conservative. You might see it produce a net somewhere between 3 to 5%, might be a little bit better, but you'll see it just continue to appreciate over time no matter what happens. That's
And
check
it's not
mark
tied to
one.
the market, which is key. And because
Correct.
it's not tied to the market, you don't have to worry about those swings, those ups and downs,
Yeah.
as if you're saying, I'm just taking it out from my portfolio right now.
Yeah.
Okay, that's great. But then if there's a downtrend and it could last for a couple of years, that's not very safe or secure at that point. I'd rather have the safety, knowing
Yeah.
It's going to constantly grow slowly. It's going to be very conservative, 3 to 4% growth, and that's you can stomach that.
Okay, got it. So I'm your investor prospect. I've got a lot of money in equity that I use for opportunities. I might have 100 grand in cash for opportunities, but I don't like to keep too much money in the bank because it doesn't earn anything, and I prefer to keep it in my real estate. So benefit number one is putting the money into the cash value, safe area to position funds, and it'll continue to appreciate over time. So with that, I've got to fund the policy though, correct?
Yeah,
Right.
absolutely. So the policy needs to be paid. You want to make sure that you're putting in a little bit extra. I always try to say, just put a little bit extra, just if you can afford it, your cash flow allows. We know what the minimum base is going to be. We know what the minimum paid up edition is going to be. Just put that in there. And if you have extra, you can add to it with some policies, right? There's different companies, they do different things. I always try to ask my clients to find out what's the right fit, right?
Yeah.
Are you able to make a lump sum? Do you have extra cash that you're like, I have a fistful of dollars extra at the end of the year? Great. That's the thing that you want to be able to do is say, how can I basically put it someplace for use that you
Right.
have for your needs in the future?
Got it. So let's say I've got 100 grand in cash that I like to keep that liquid for home renovations, whatever it might be. Say, okay, I get this. I'm interested in a policy. What I want to start with though is just moving this 100K that I've got in cash into a policy because I understand the growth, everything that comes with it. Can I just write you a check for 100 grand and be done with it?
Yeah. So yes and no. You don't write me a check directly. It goes to the insurance company.
Right.
So we
Yeah.
work with that. There's going to be a process for getting a health rating, trying to make sure that everything's going to be okay. Your ticker's good and you're going to be living for many years. So they'll definitely want to make sure that it's going to be a safe for the company, right? The
Yeah.
underwriters trying to make sure that there's not going to be a check that's going to be written out as a death benefit right away. So there's a process that we'll work you through. But we also
Okay.
want to find out, is this going to be something you're going to be doing year after year? Is it going to be a little bit less year after year? And that's okay. There's a lot of flexibility to these, Steve, and that's what I like about it. You have
Yeah.
the flexibility of how much you want to add, and we can try to drop it down, and we can design it to make sure that it's the most efficient policy based on what you're trying to accomplish.
Got it. Okay. So assuming I'm healthy, if I just want to do a one and done lump sum of 100 grand, can I do that with a policy? Like, is that what you would recommend or a bit different?
Yeah, so that's a really good question.
Yeah.
Can it be done? Everything can be done. Is it going
Yeah.
to be the most pretty and the most efficient? No, it's not. And so typically what we try to explain is that depending on your age, the older you are, you're going to have a little bit longer period of payments that go into a policy. The younger you are, you might be able to get away with a single premium.
Yeah.
The main thing is we want to make sure that you're paying into the policy enough so that the cash value and your death benefit don't start working backwards, meaning it's not very efficient. The policy's trying to feed itself. If you're not paying those payments, it's going to try to eat away at your cash value. And then you might come back to us to say, why is this occurring? So I'm always upfront with everybody to say, we can set this up based on what you're trying to do. So if you're trying to do, let's say $100,000, we know that the base is going to start out somewhere around 10,000, just to put into the policy. That's what it's going to be asking
Yeah.
for to be fed every year. We might be able to do that for 3 or 4 years.
Got it. So thanks for going over that. Typically, how I like to explain that too is very similar. So if someone said, I've got 100 grand lump sum, I want to get this into a policy and I don't want to pay a penny after. Like, I just want to move this in, get it in. If something happens, I can add more. That's great. But that's the money I want to give you. We're the insurance company. Like, how would it work? Well, I'd say, well, you could just write a check one time, throw it into the policy. The cash value will look good in the first year. After that, it won't look good because you'll find you'll need to carry a high insurance expense. And I can show you exactly what that looks like just so you've got a visual there. What I might recommend is taking that 100K lump sum and breaking it up over 3 or 4 years. Say it's 4. That's 4 easy payments or 4 even payments of 25K per year. And the reason why, Mr. or Mrs. Client, is because if we do it that way, what you'll find is the actual cash value growth, called the net returns, the internal rate of return, is going to be at its absolute highest. So step one, we always like to progress through is before we look at using the policy for real estate, how do we maximize the cash value? Because if you have more cash value from start to finish, You've got access to more equity as it continues to grow, and it just makes life better because you've got more money that's working harder for you. Does that make sense? Any questions on that? Typically is what I'll progress through. Does that make sense? Or anything you might add there, my friend?
Yeah, so there's a couple of options that are out there too. The insurance companies have like a holding place where they'll give you interest on the policy as well. So you put it into a holding area. You only wrote us one check, right? So it didn't go to me, but it goes to the insurance company. And then the insurance company can then pay for itself to say they're going to be based on the design. You pull out cash from that account that's going to give you, interest at 5 or 6%.
Yeah. So it's a premium deposit account is typically what those are referred to as. Yeah, but it's a holding account. It's kind of like a high yield money market where I just throw money in. Drawback though is I can't access it while it's in that account. I've got to wait for it to feed the policy. Our money,
Correct.
yeah, goes to the
And
deposit account. Go ahead.
yeah, no, I was going to say, and that's again why we like to ask questions. What are you planning on using
Yeah,
your funds for? How soon do you want to be able to have access to it? What are some of the limitations? And so we want to make sure that people are well versed as to, I gave you one payment. When do I get my cash back? How much is it that you want? And what's the reality of it? If you were planning on paying for a policy for 4 years and you put it into a PDA, yeah, the money's basically put off to the side for those years. You can't touch it. If you put it into your policy, now you can start taking it out within 2 weeks after you put it into the policy.
got it. Correct. Yeah, the 2 week turnaround time is nice. Sometimes a little bit quicker.
Sure.
So let's assume that I say, all right, I get it. Moving this 100K lump sum into a policy over a certain amount of years. I understand and see right on the illustration, guaranteed and non-guaranteed values. That's going to give me the most overall value long term. Let's assume I'm comfortable with that. What's step two as to why I would then use the policy instead of accessing equity in the property that I own?
Right. So your property is going to be maturing, right? You're going to have maybe a 3% growth, from the property. Your insurance policy is going to be growing between 3 and 4% as well.
Okay.
So the main thing is having that liquid cash that you can get it within 48 hours. It's not going to be tied to the market, so you don't have to worry about the swings. Your property, it can go up or down because depending on what's going on with the market. And so the nice thing is you've got this policy with a life insurance company that's slowly growing, and you still have that access, to get the cash. So now you can start leveraging it. And,
Mm-hmm.
you can take out your money that's going to be tax-free. You have your property. Somebody's going to come back to say you sold something. What are you going to be able to do to keep it from being taxed, without rolling it over into another property? Maybe you want to do something else with the cash.
Yeah. Kind of compare the two side by side. So you've got the real estate, which will continue to appreciate over time. But to your point, there might be some fluctuation, right, as the years pass. The life insurance policy will do nothing but appreciate.
Correct.
If you want to access funds in the property, if you've got a line of credit and a relationship established with a bank, that's very, very easy. It's easy to access the funds. Typically, it's the same day. With the payments, this is again with real estate, typically it's payments interest only at a minimum, and then you pay it back usually at your terms in terms of principal payments. They can call it. I haven't talked to too many people that have actually experienced that, but I know it has happened among some. Yeah, especially when things get rocky in the economy. But there is a little bit of uncertainty there or an element of no control for us, more so the control is in the bank's hands.
Correct.
Whereas with a policy, so that if you take a loan, interest does accrue, however, it's optional to pay. Typically, we recommend it. You'll be billed one time per year on your policy anniversary date, but the payments are 100% in your control. You can pay it just the interest only one time per year. You can throw money at the principal balance by logging onto your online portal. Very, very simple, but it's very similar. Call it a loan. We can refer to it as a line of credit against our policy, like what we would have with a bank on property that we own. The difference is it's 100% in your control in terms of how you pay it back, when you pay it back. You've got a lot more flexibility. The insurance company is not going to call it like a bank would. More control. And I know that does give a lot of people peace of mind.
No, absolutely. I've had several clients who basically said, look, if I go to a bank and I try to get a car, I have to start paying within 60 days,
Yeah.
maybe 30. So here you can say, I'm going to push it off because I have other things that I want to be able to do, and my cash flow won't be better maybe 6 or 8 months from now. Maybe I'm in a position where I lost my job and now I need to be able to pay for something. At least you have the minimum amounts that's going to be out there, and we have the ability to say, you know what, that loan, we can deal with that portion of it, just the interest only. If we have enough cash value in your policy, then we can start taking out from the policy to at least get you by until the cash flow gets better.
Correct, correct. There you're referring to if you have an interest payment due and you can't pay that, but if you've got sufficient cash value, you can just have the cash value take a loan against itself to cover the interest. Yeah,
Correct. Correct.
yeah,
Like there's two sides of the coin. I want to use my policy and I'm going to loan out everything in it. Okay, there are repercussions to that. We want to make sure that we know the pluses and minuses. If
mhm,
you stay, about 80 to 90% of your cash value, now you've got a lot more room to be able to say something happened, life happens, and we know it does. You just look to see like what happened next week. We don't know, but
right.
last week we can say we know what happened. So always plan to say, how can I make sure that we're going to be on the positive growth side and not get to the situation where I've overextended myself?
Yeah, what's the worst case scenario? So typically, like that, you can talk about it with someone, but it can be difficult to grasp. That'd be like you or me speaking to an engineer and asking them to explain exactly what they do. And after one time, we know it 100%. It's
Yeah,
not
it's
going to
not going to
happen.
happen.
No, it's going to take a lot of time and repetition. And typically, we've got to work it. Like we've got to be hands on, understanding it. That's really when we learn things and we grasp them fully. So typically, like what I've seen work really well in these situations when someone wants to see, hey, what's the worst case scenario in case everything goes south? What I would say is, well, first we can look at your policy. What's it look like with the money going in and just let it sit and grow over time. Take that exact same policy and then look at loans coming out. And when you take those loans out, the plan might be to pay them back, but pretend everything goes south and you're unable to pay any of the principal back and pay any of the loan interest. Now you can see year over year, if I don't pay anything back, and let's say I don't even pay a premium afterwards as well because everything just goes south and I don't have the resources to, what happens with the policy? Does the value go up or does the value go down and eventually get to a point in time where you have to pay something? So that's
Yeah,
the, go ahead.
yeah.
Yeah.
No,
Mhm.
there's a lot of variables in there, Steve. You have to find out, A, how much have you been putting into the policy?
Yeah.
How much was your loan? Did you take out your loan right away, or was there several years that went by so you have growth that's going in and that's really helping you? How fast are you paying it down? Are you paying anything into it? So all those variables we need to take a look at.
Yeah.
And sometimes it gets very interesting where people are saying, all right, I've been putting into the policy for 5 years. I've been putting into the policy for 10. Now I'm in my 70s. Do I really need to pay back the loan? And
Mhm.
sometimes the answer is no. It just depends on, again, how much of those variables are there. But I'll always say, you should try to at least pay at the minimum, pay back the interest on these loans. And then we can always run the numbers to say, all right, what is it that you're trying to do? How much is this going to cost you? Because again, if you took out, a loan for, let's say, $50,000, and now your interest that you've been paying is more than the $50,000, you might as well paid off the interest,
Right.
or paid off your principal. So I always try to make sure that, hey, how many years are you planning on doing this? And if that's the case, maybe we should start thinking about hitting towards the principal to bring down that loan amount, if you're going to be paying that much in interest for all those years.
Yeah, no, and thanks for mentioning that. I mean, seeing it laid out does help a lot of people. And if you've done a good job funding a policy, so if someone's aggressively funded it for 3 to 5 years, and when I say aggressive, I mean you're paying 10 times the base premium PUAs, you're at a point where you could stop paying altogether, not even pay the premium, and the cash value will continue to appreciate at a very, very attractive rate as time passes. So if I'm there, if I've got a 3 or 4 year old policy, typically I'm there, provided I've pumped it with PUAs. If I'm in a situation where I have a large loan balance and a lot of loan interest that's accruing, and I'm still paying my premium, a lot of times what I'll recommend when we look at the numbers is, hey, it might make sense to stop your PUA payments, maybe even stop your premium payment for a period of time and just redirect all of your resources toward the loan interest and the loan principal. And we either do that until the loan's paid off, if you just want it cleared, or if you said, no, I want to keep on getting money into the policy because it continues to compound for me. That's common to see. If that's the case, then typically what I like to do is say, okay, what I would do then is put the PUA payments at minimum on a pause, maybe even the full premium, attack the loan until you're at a point in time where the net cash value growth, the dollar amount you're receiving from the insurance company, exceeds the interest that's due, that's being paid to the insurance company. Because what we don't want is the interest due to the insurance carrier to exceed what they're giving us. So if it makes sense to chip away at that loan for the next 2 or 3 years until you're at a point where now all of a sudden it's in your benefit, you're getting more than what you're paying, okay, now you can begin to repay or begin to pay the premium again, reinstate the PUA rider, whatever it might be. But what we want to do from a number standpoint is just make sure you're not in the red. And sometimes walking someone through, going line by line is exactly what they want. And then some people say, just tell me what to do. Like, yeah, how do I make sure I'm not in the red? Yeah.
Exactly.
Mhm.
No, and that's why, we want to make sure that we're taking the time to understand what are you trying to accomplish? What are the resources you have to work with? What is it that your goal is, the end goal, and make sure that we have an idea so that we can say, is this the right tool? And we can always adjust it, within reason. And it's just more or less trying to figure out where do we move that to make it most efficient for you.
Yeah, that is the key. So let's go back to me being someone who invests in real estate. We can wrap up with this. I'm investing in real estate, borrowing against the equity to acquire more real estate. It's what I've always done. I say, okay, why would I do this? Or like, what do other people do in in the same position I am? Like, typically, what do you see? And just like, give me a quick overview of it so I can know if it's a good idea or bad idea.
Yeah,
Yeah.
so it's one of those things of saying, like, first off, where are you getting your cash from to make the payments right now? And if you're saying, I'm going into the bank, how much interest are you making?
Money's there. Yeah.
Yeah, money's there, but are you making any interest in the bank?
No.
No, you're not. Okay. And the next thing is, if you take out cash and you're putting it into something else, what do you expect that future growth to be in that new investment, perhaps? Investment could be property or it could be in a portfolio.
All I put it in is my property, just real estate 100%. Yeah.
Right. So if you're putting into your real estate property, it's going to be growing for a certain amount. But imagine if you can have two tools working for you to actually generate income. So
Yeah.
you have a life insurance policy that's also going to be getting guarantees and dividends that's paying into your policy because you put money through it. And by putting it through it, it's still generating for you. Even though you take out a loan, it's still generating income. If you just pay out of your own pocket to say, here's my cash flow in, you're only getting from one tool, and that's your property only.
Mhm.
What I'm trying to say is you've got two tools. You've got the life insurance policy that's going to be growing for you, and you have your property itself that's growing. So you have two things giving you interest and guarantees, to help grow.
Yeah, the guaranteed piece is nice there. So typically, like what I've seen move a lot of people in a manner where they say, okay, I want to put money into a policy now, is they view it as a safe place to position capital, continues to appreciate. I can access it like my own personal line of credit. I don't have to deal with a bank. I get access to my cash very, very quickly, typically within a few business days. I can pay it back however I'd like. But when I borrow against it, to the point you mentioned earlier, just like my real estate, I continue to receive appreciation on the entire asset. So if you've got 100 grand in cash value and you borrow $50,000, what do you continue to earn dividends and interest on?
Yeah, both.
The full 100. Yeah, and then you pay interest on the outstanding 50, just like you would with real estate. So I can relate to it as a real estate investor because I'm used to it already with real estate. I'm just using a different asset. The difference is cash value is guaranteed to go up. Very, very easy to access. I've got liquidity there. There's no qualification process ever. And then you've got the tax benefits, which we didn't really talk about at all, which is pretty simple. If you do everything right, you can access the cash value tax-free.
Correct. Yeah,
Yeah.
that's the key too. It's like when you start talking to people, and I've mentioned this to several people just recently. So late 2023 and early 2024, they're telling me how long the process is to get a loan. They're being asked more questions, and the process is taking a lot longer. So if you're not getting pre-qualified for your loan, all of a sudden, you could be sitting there 60 days later, and you're like, I just lost that opportunity. You have a policy with us, and then within 48 hours, 48 hours to 72, you could possibly have cash in your bank.
Yeah, the time and convenience, I know personally that one's big. Um, right now, like my wife and I are looking at a property, and the thing is like, okay, do you finance with a bank because then you keep more cash liquid, like that's typically why people do that, or if you've saved money in the cash value of a policy, do you just use that to pay for the property in full and then pay the policy back? And yeah, you can talk about how the money's always at work for you. That's a nice feature. You can pay it back at your discretion. But the real appealing part for me, just as I've aged over the years, if you want to call it that, and gained a life experience, you don't have to deal with like the banks anymore and the hassle. So literally you say, okay, I've built the savings in my policy over here. So let's just access the cash here. When I pay it back, I see it restored plus all of the interest it's been earning all the way through. And getting the money is literally just requesting it, shows up in your bank account, and then you write a check for it and you're done.
Correct.
So it makes life easy there. Like the key is like it's being disciplined or making sure we actually save the capital over time. That's important, which everyone's different, to the point you mentioned earlier, whether I want to have the option to keep on feeding it. Some people like that. Or you'll see some people say, hey, I've got a lump sum of money. Let me get it into the policy, then never pay another penny in. It all depends on the individual situation. But once it's built up, like that's where the convenience really comes in, I feel like, because you don't have to deal with banks, institutions, or anyone else. You can move quicker.
Yeah. So here's a question that popped up.
Yeah.
Somebody basically had a loan outstanding. They've been putting in, $10,000 a year, and it came up where they've got $40,000 extra, and they wanted to start with a single premium. And I said, you know what? A single premium is not really going to be your best interest. And they were like, well, what do you mean? I thought this would be great. I get an extra death benefit. I have a single premium policy. And it's like, well, for the amount of money that you're putting in, why not pay off the loan and then use the extra $10,000, because they had $30,000 loan aspect, pay off the loan and then put the other $10,000 into next year's premium. And then that way you have better cash flow. It gets you more cash availability to say, if I need to take out a loan, it's now the $30,000. Your loan has basically been wiped clean. You're not paying the interest. You're not losing the cash from that first year when it's the worst year, right? You put all that money into it and all of a sudden the insurance company takes out their fees. Put the money in to pay off your loans or use it to max out your policy if you've missed any payments in the past.
Yeah, their MEC limit's 10K, like as a policy where they fund a max of 10K and they've got an extra 40. Got it. So when you mentioned that to them, what was their reaction? Did they come back?
They were actually surprised. They were like,
Yeah.
why would I want to do that? Should I be paying, my PUAs? And it's like, well, you could keep putting money into the policy, but the whole key is, why are you paying all that interest every single year?
Yeah.
Where that's going to eat away. That's why people's net wealth, if you will, is being eroded if they don't take care of the interest that they're constantly paying.
Yeah, no, so nice work. Firstly, I am a fan of attacking the loan interest and loan principal before paying money into PUAs. Some people prefer to continue to pump money into their PUA rider because what's happening is you pump more money into the policy, everything's compounding for you. The thing is, when you look at the net cost to borrow, the loan interest rate, versus the net internal rate of return, not the dividend because that's gross, but the net growth rate, typically the cost to borrow is higher than the net rate you're receiving on your cash value. So what we want to look at is, are you paying more in loan interest than what you're getting from the insurance company? And in most cases, especially within the first five years, really first 7 years of a policy, the net IRR is going to be noticeably less than the actual cost to borrow, the loan interest rate.
Mm-hmm.
So usually from a pure numbers standpoint, it makes more sense to dedicate resources toward the loan so you pay less in loan interest and you're at a point where the gains on the policy are exceeding the money going out in interest costs.
Correct.
So from a number standpoint, that typically makes the most sense. So if you're laser focused on the numbers, how do I get the highest overall return? That's usually the route to go. Then we'll ask, does that make sense? Any questions on that? And then after that, here's the other side of it. I've seen a lot of people say, okay, I understand that the cost to borrow is high right now, higher than what I'm earning. I'm still in favor of throwing my money into the policy, into PUAs, because I'm really looking at it from a long-term standpoint and I want that long-term compounding on everything. I say, okay, that's perfectly fine. A lot of people do that. What I'd recommend at a minimum in that case is paying the loan interest. That way it doesn't compound. And what we can also do for you is just lay them out side by side so you can see each year, what am I gaining from the insurance company? What am I getting from them? And then what am I giving them in loan interest? Because when you see it each year, yeah, if you see, hey, I'm paying them $5,000 more than what I'm getting, yeah, I get that I'm going to make it back long term, but how many years does that actually take? And do I get that sick feeling in my gut when I see that? If that's the case, well, let's attack the loan a little bit to get rid of that sick feeling. Now you'll sleep better at night and you'll be much more productive. So I want to make sure we talk about that and make sure it's very, very clear because it can be complex for a lot of people. We've got to go through the different items one at a time.
Correct.
Mhm.
Yeah. And it's one of those fun things where we're pulling out a lot of data that's not always so easy to find, right?
Oh my goodness. It never is. Well, I shouldn't say never. One day I think insurance carriers will get there. But if you just ask, if someone asks you, hey, what did I earn last year on my policy? Like how much did I get in total interest or total dollars? Can you access that in 2 minutes?
No.
No. They'll give you the dividend and everybody thinks that's what I'm like earning, but no, that excludes the guaranteed portion. So yeah, there's multiple steps as far as getting that information, which you can do, but for now it does take a bit of time because you got to pull data from different resources and put it all together. But that's where it does take some time and just setting expectations properly and helping people navigate through it, make sense of it. When people understand how it works and how it benefits them, they typically like it. But if there's a lack of clarity, that's usually a situation where situations pop up later. I thought it was one thing and it's actually not. Yeah.
Correct. No, absolutely. And that's why again, it's constantly asking those questions to make sure, things do change.
Yeah.
The cash flow changes, things could get better for you. You might have extra cash. I always try to tell our folks, if your cash flow gets to be positive and you actually have a fistful of money, at the end of the year, now we can start talking about like, all right, did you max out previous payments? Did you max out your current payments? Did you pay off your loans? And if those answers are yes, 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 and yes, great. Now it's good time to be able to start another policy.
Yeah.
But
Yeah.
people have that misconception. Oh, if I have more than one policy, I'll be making more money. It's like, not necessarily. We've got to ask, how often are you going to be paying afterwards? Are you just going to be making a lump sum and that's it? Or do you want to have the potential for it to be able to grow higher? And max out everything, so
Yeah.
utilizing those buckets for your most efficient.
Yeah. Multiple policies means multiple upfront hits and multiple times where it takes several years to break even. Where the flip side of it is someone who says, okay, let me start with a policy where I go a little bit higher on the mech space and the minimum premium upfront. This way, as my situation improves or if my income goes up, I can continue to add more money to an existing policy where if I'm a couple of years into it, I'm over the expenses. So it keeps on snowballing as time passes and I don't have to go through that again. So there's pros and cons to both. Like that's always a fun conversation up front to help someone really find the sweet spot. How big do I want to go? Because you don't want to go too big. That can hurt you too.
Right.
Yeah.
Let's be realistic about it, right? So there's things where we want to make sure that, if you can't do this in the next 5 years, then let's try to shorten it down to be super efficient with it.
Yeah, exactly. Perfect. Well, thank you so much for your time. We are just about at the top of the hour. Any concluding words, Mr. Timmons, before we wrap up?
Just give us an opportunity to work with you and ask the questions to get you the right, most efficient policy. So
yeah, certainly. Well, if you'd like to connect with Steve or anyone on our team, we've got our contact info below. We've got Steve's direct email there. Feel free to reach out. And as always, I hope this helps.